I'd like to welcome Daniel Taylor to Knowledge at Wharton. He's a professor of accounting here, and he's written a very interesting paper on the connection between political connections and insider trading during or just after the financial crisis and during the period where TARP was under consideration, and TARP is the Troubled Asset Relief Program.
That's right.
And so I'm going to let you give us a short summary first, and then we'll get into more specific questions about what your paper is about, what it found.
Okay, so what we did in the paper is we look at the trading of corporate insiders. So by corporate insiders, we mean officers and directors of publicly traded corporations. All of these individuals have to file what's known as Form 4s with the SEC in the public record that discloses their trades in their firm's shares or their firm's stock. So they're allowed to trade in their firm shares, and they file that information with the SEC. So what we did is we gathered all of the information that's out there on these Form 4s, on their trading. And we looked at the trading before the financial crisis, during the financial crisis, and after the financial crisis. So this is the trading of executives and directors in their own firm. And we looked specifically at financial institutions. And so one of the big questions that comes out of the financial crisis that's interested, in Wall Street and on Main Street is, did anyone know? Did anyone see the crisis coming? And so we initially started the project by looking at, okay, can we see whether insiders, corporate insiders, officers and directors, traded in advance of the crisis? So did banks that did poorly during the crisis, did their executives sell shares before the crisis hit? And then we looked at the trading during the crisis, so around the bank bailouts, the TARP monies that you alluded to, and then sort of after the crisis, what did it stabilize? And we found that there didn't seem to really be any evidence of trading before the crisis. There was no evidence that insiders traded in anticipation of the crisis. But we did seem to find some evidence that insiders traded during the crisis in the period in which the TARP funds were dispersed. And then we investigate that a little bit more, and what we find is, interestingly enough, that it's only the insiders that had political connections. And by political connections, I mean connected to a bank regulatory agency or the current House or Senate at the time. So we looked at bank boards who had a director or officer who had work experience, current or past, at a bank regulatory agency, the Senate or the House, and we found that the boards of those banks that had those political connections traded more heavily during the financial crisis. Their trades had higher predictability of outcomes during the financial crisis. So they predict, for example, the market reaction and the amount of the bailout that the bank would receive. So we basically find that during the crisis, there is some trading in anticipation of bank bailouts. And then after the crisis, of course, things go back to normal, and we don't really find that those trades or those individuals' trades have any more information than otherwise.
So this would seem to be the definition of insider trading on the face of it. So I wanted to just point out, because I think it's very interesting, that this study had a very large sample.
Right.
It looked at 7,300 corporate officers. Is that right?
That's right.
Across 497 publicly traded TARP-eligible institutions. So
that's correct.
This was a very wide net that you cast.
Right. I mean, one way to think about this paper is to think about it as using big data and computer algorithms to sift through public information on the trades of officers and directors, and to see which trades of the officers and directors are correlated with future outcomes. And so we would say if a trade is correlated with a future outcome, if it has a high predictability, it's more likely that trade might have been based on information about that future outcome. But I do want to clarify that in the popular press and legal scholars, they use the term insider trading. Yes. They're thinking of illegal insider trading. When we use the term insider trading, we're thinking of the trading by officers and directors. So when we say insider trading, we mean trading by corporate insiders. And there's two types. The first type is the legal trading. So this is they can, the board or the CEO can trade in his shares, just like anyone else can.
With proper disclosure.
With proper disclosure, as long as they do not have any private information. The illegal kind is when they have private information that they have not disclosed to shareholders. So this sort of relates back to a set of rules called disclose or abstain. So if you're a CEO or a manager and you have private information, it's your duty to either disclose it to shareholders or abstain from trading. And so in this setting, it's a little bit more murky because when we're looking at political connections and connections to bank regulators, it's not really clear how the manager would disclose any information that they would have gotten from their connections. So, for example,
because it's not definite information.
Right. So,
it's something someone is telling a bank insider, it looks likely that this is going to happen. So legally he doesn't really have an obligation to disclose something that's not really certain. Is that right?
That's correct. That's correct. And so I think, there's been a spate of recent insider trading cases that have gone, that the government has prosecuted. And, out of those insider trading cases, the definition of illegal insider trading has become more murky.
Slippery.
Yes, more slippery. And so I don't think it would be wrong to suggest that this paper has sort of a smoking gun.
Okay.
What we're doing is we're reporting correlations on, as you mentioned, a large sample, and casting sort of a suspicious eye in the direction of insiders that have political connections. I mean, if you go back to all of the books and the popular press during the period, the bailouts were effectively decided in, backroom meetings with sort of insiders. There's a great book, Too Big to Fail,
yes,
by Sorkin that sort of details sort of all of these, his interviews with people. And so a natural question is well, if the bailout's being decided in private and in consultation with, bankers or, Treasury officials or government officials, how does that information sort of leak out?
So I think that it's also interesting to note that this was not the result you were expecting when you started out on this path. Could you just talk about that briefly?
Right.
How this surprised you?
Yes.
The results surprised you?
Yes, absolutely. And frankly, we're still kind of stunned at the results. And so when we started the project several years ago, as I mentioned, it was sort of like a big data study. We sat down, the co-authors and I, and talked about, okay, does this, this would be interesting. Does it make sense? Because there's all of this concern about did they anticipate the crisis. So we began the paper thinking, okay, we would shed some evidence on whether they anticipated the crisis or not. And sort of 5 years ago, that would have been sort of a very timely, finding.
Right.
They did anticipate the crisis, or they didn't anticipate the crisis. But it took us a little longer than we expected to gather the data and to do the analysis. But the analysis was, a couple of months of, coding and gathering data. And so when we started doing the analysis and we realized, okay, we're probably after the crisis, let's add some more data. Let's add the post-crisis, the bailout period data. Let's add, the data from, 2010, 2011 into it and run the analysis. We found, somewhat surprisingly, that there was this, blip, for lack of a better term, in the correlation between insider trades and future performance during what we call the bailout period, and that's the period from when TARP began dispersed in October through June. And so when we saw the blip, the next question is, okay, where is the blip coming from? Why is the blip there? And so then we found that the blip only occurred in banks that actually received TARP money. Okay, so then we could think about like an investigative journalist,
right.
Dig deeper. Okay,
Right.
So now the blip is only in those banks that received TARP money. Okay, so then dig deeper. Look at the connections of the individuals or of the bank. Okay, well now the blip is not only in banks that received TARP money, it is also only within that set, also those that received TARP money and had ties to former or current bank regulatory agencies like the Fed, the Treasury, the Office of the Comptroller of the Currency, the FDIC. And so that's when we said, wait a second, is this actually, is this actually where the blip is? And so, my co-authors and I are actually pretty suspicious and skeptical people by nature. So in terms of data analysis, we threw everything we could at it to make it go away. And so I wouldn't be here if it went away. And so this isn't a case where we're trying to cast some suspicion on something that may or may not go away. I mean, this is a very, very robust result. I also want to mention that the data on political connections, it was not like we collected this data or that we generated this data. Everything in the paper is generated from public available information. So it's perfectly conceivable that somebody could go out there and investigate it themselves. The data on political connections, right? Where do you get data on political connections? Well, in the bios of directors and officers in the annual reports, they list what their current and former work experience was. So everything that's in the paper is sort of out there in the public domain.
So you weren't using any insider information?
No, we were not using any insider information.
What are some of the practical implications of these findings? So I think it's really interesting you pointed out that the alleged criminality of all this is questionable because the information they had wasn't necessarily actionable in the way that they had to disclose it. But if someone was whispering in their ear and it was good information, it seems a little bit, it seems sleazy, right, to put it mildly.
Correct.
So what practical implications could come from this? I mean, for example, this speaks to the damage that can be done with the revolving door of government officials, having come from industry and then going right back into industry, perhaps without a proper amount of gap in time.
Right.
But I'll leave it to you. What are some of the practical implications here?
I think that there are probably, I would say, two main practical implications. The first is we need to give some more thought to what exactly constitutes illegal insider trading. I think right now, in light of recent court cases, there's a big gray area out there. And I think a lot of people would be surprised at how gray the area actually is. So you need a smoking gun to be able to prove an insider trading case. And it's very hard to get that smoking gun. You have to get the tipster. The tipster has to confess. There has to be a series of dots that you can collect. It's
tipster who may have benefited
Correct.
in some way from this to begin with.
It's difficult to do that using a large sample with correlations. But this suggests areas where people may want to shine a light. So think about it as this insider trading is a dark room. We're shining a light. It's not entirely illuminated, but we've got a good area where people should look. The second one is, like you mentioned, the revolving door. There are a series of studies in the academic literature on political connections, and specifically political connections of financial institutions. So, for example, there's a recent study in the Journal of Financial Economics, and they found that this was before Tim Geithner was made Treasury Secretary, that when he was announced to be the Treasury Secretary, the banks that had connections to him, either on the board seats or whatnot, experienced massive increases in shareholder value. So what this is saying is that the market is aware that there is this connection between bank regulators and the banks in which they are regulating.
Right.
So, for example, many people are surprised when I say go to the Federal Reserve's website. You can even look during the crisis. Lehman Brothers CEO was one of the board of directors of the Federal Reserve. Jamie Dimon was on that board at all.
And of course,
well.
Paulson himself
Correct.
was heading that backroom deal
Right.
that you alluded to earlier.
So you've got this, marriage is too strong of a word, but you have these very strong connections between the regulators and the people that they're regulating. Now that's good and bad. On the one hand, you want somebody knowledgeable about the industry and how banks work to regulate banks. But where it becomes questionable is, are there conflicts of interest? And sort of our paper suggests that yes, there are conflicts of interest, and these conflicts of interest are potentially pervasive. And I don't think that's really been given enough sort of consideration out there. Is that there's a good side to having a banker regulate the banks, and there's also a bad side.
Did you attempt to quantify any of this, like how much some folks may have benefited?
Well, so the benefits are tricky because what we're looking at is what we call opportunity profits. So when an individual trades, if their share price goes up, let's say 6%
Yes.
over the next, say, month, then that means that they've earned a 6% return on their money if they sell. But we can't match buys and sells. So we can't actually compute a measure of realized profit. All we can say is, well, you bought this month, stock
Right.
price went up 6%.
Right.
That's 6% more than you would have made
Right.
if you had waited a month.
It's usually better when it goes up, I think.
Yes, no, that's right. And so in this case, we look at the trades in advance of the TARP infusion. So we know the date of the TARP infusions. We know the date of the trade. And so we look at the trades, and surprisingly, we find a significant amount of trades, both in volume and in dollars, clustered 30 days before the bank actually receives a TARP infusion. Now, I have done some work on insider trading policies in my prior research. And what was surprising to us is that most companies have something known as trading blackout windows. And a trading blackout window is imposed by the company in the Code of Ethics on the officers and directors, and it says you shall not trade N days, typically 20, 30, 40 days, in advance of a material event. So, for example, for an earnings announcement that firms make on a quarterly basis,
Yes.
insiders are prevented from trading, several days in advance of that earnings announcement. In this case, if there was a blackout window applied to the TARP infusion, those trades should not have existed. So what this suggests is that either the event, the TARP infusion, was unanticipated, so a blackout window could not apply, or that they sort of skirted their firm's blackout windows.
Just one final thing. I just wanted to focus on the no smoking gun comment that you made at the outset. So this seems like pretty clear evidence that there was insider trading to me as I read it. Very strong evidence, and yet this isn't pointing to any individuals or necessarily. I mean, you were sort of doing this globally, and the information that you have, while interesting, isn't the kind of information that someone takes to court. It's the kind of information that an investigator would use to say, here are the most interesting places to look if I were going to try to find a wrongdoer.
Right. So I guess I would think about this as sort of as an academic paper on the costs and benefits to political connections. So most of the academic literature has focused on the benefits that the shareholders in the firm receives from having political connections on the board, right? So it may very well be that, you like, as a shareholder in the firm, you want your bank to be politically connected because you're more likely to get bailed out, you're more likely to get special favors. And so most of the academic literature suggests this is a good thing for shareholders.
I see.
Not necessarily for the government, for the public, but for a narrow set of shareholders. What we're coming along and saying in the this is the sort of the academic debate is there is also a cost. What is the cost? Well, the cost is if you have these political connections during the crisis, they may engage in some, for lack of a better term, shady trading. That shady trading comes at a cost to shareholders. So who loses out from the insider trading? If the executives traded with private information, it's other shareholders who potentially are on the other side of that trade, and they lose out. So this is really about sort of if you think about academics as okay, political connections have a benefit to the firm, and we're documenting one cost, which is sort of extracting rents. What we say is rent extraction from
And also
shareholders.
the potential cost or the risk of being exposed and what that could do
Correct.
to the bank's stock.
Right. No. So I don't want there to be one shouldn't ascribe any sort of policy agenda or anything like that to the paper or to the findings. We're just basically saying, look, there's this cost of political connections, and and by the way, this is not a trivial cost. This seems to be a big deal, especially in light of all of the debate about TARP, how the bailout monies were doled out, the decisions about how of those things were given out. And so hopefully something like this doesn't happen again, but it does suggest that these conflicts of interests do have real costs for the bank shareholders. Even if the bank gets bailed out, the managers or the officers and directors may have traded on private information in advance of that actual bailout.
Any idea of how many people were involved in that potential violation?
Well,
those potential violations.
It's difficult because it's hard to say whether anything was actually whether I can't go, since everything's based on correlations. I can't go around and say you, this firm, that firm, this firm. All I can say is the set of firms and the set of individuals where the correlation is particularly high.
Okay.
Now, those trades may have been conducted entirely legally, within sort of the purviews of the existing insider trading rules, and by chance, there was a very high correlation. But the fact that we find this correlation so pervasive, as you mentioned, and specifically focused within those that are politically connected, suggests that there is, it's not just one or two or three individuals. They would not be able to drive a result on 73,000 insiders, or 7,300, 7,300 insiders. But, it's sufficiently pervasive that, it's able to generate a large sample result.
Thanks for coming in today. Really appreciate it.
My pleasure.